No cap on gains and less risk. Can you really have both? This is Inside ETFs, and we're talking about uncapped buffer funds. In a market whipsawed by tariffs and geopolitical shocks, many investors are staying cautious and missing out on this year's rebound. That's where buffer ETFs come in, built to cushion losses while still offering some upsides. But critics argue most have underdelivered. Mike Loukas, CEO of TrueShares, says that there's a better way. Uncapped buffer ETFs, designed to protect on the downside without capping gains. It sounds ideal, but can they really deliver, or is this too good to be true? So Mike, critics say buffer funds offer low returns with more risk than simple strategies. So do uncapped ETFs actually solve that problem?
I think they do, and of course, with any strategy, it's relative to the environment that it's in, right? So I think that with uncapped buffered ETF strategies, which we pioneered over 5 years ago at this stage, so we've got plenty of live empirical evidence, you have the ability to mitigate risk, but not truncate the upside. In terms of why you're in equities to begin with, and most of these products are equity based, you're in for the growth characteristics. So, yeah, we agree that you should do everything possible to address both tails, the right tail, the good tail, right, the upside volatility, and the left tail. And we believe that we can accomplish that in one strategy, which is our uncapped buffered ETFs.
So these products won't shield against deeper drawdowns. Can uncapped buffers really protect when markets plunge?
They do. And, I like to say that these products are based on math. I think in the active ETF space and the investing space in general has always been a debate between passive and active. But the reality is there's a new category, and that category is math-based. And so defined outcome ETFs, like the buffered ETFs, are really based on math. And they'll do what they say they're going to do, provided the expectations and the context are clearly communicated. So in this situation, will they protect against long-term drawdowns? Yes, but they have to be held for the investment period. And I know that there's a variety of investment periods out there. There's 300 plus different buffered ETFs in the marketplace now. So understanding what that means and the idea that there's a little bit of a yo-yo effect inside that investment period. So you may have a draw. We saw this in April, Liberation Day. We saw a big drawdown. A lot of these products floated down with it because of the short-term nature of the sharp drawdown. But then that buffer kicks in over the remaining investment period, and you see that risk mitigation.
So with uncapped buffers, investors get nothing until the spread is cleared, then get everything after. So is this just feast or famine investing?
Well, in some formats, yes. In the TrueShare structured outcome format, there is no spread. So from the first incremental upside move to the largest upside move, our investors participate. We give them an upside capture from zero right on up. So what that means is, say you had an 80% upside capture over a 12-month period. If the equity markets are up 10, you're 8. Equity markets are up 1, you're 0.8. Equity markets are up 100, you're 80. So, that upside capture, some other peer classes or groups do have a hurdle. We do not have a hurdle. So it starts from zero and continues all the way to an uncapped limit.
Well, BlackRock is forecasting that defined ETFs could hit $650 billion by 2030. Is this the beginning of the buffer fund's rise in popularity?
What structured products allowed investors to do was tailor their own performance goals individually. And now with these structured product strategies jump on the fence into ETFs, and the buffered ETFs are sort of the first wave of that. We are simply allowing investors to customize the outcomes of their individual portfolios. And so I think that's a huge theme in the marketplace moving forward. And whether it be buffered ETFs or the different structured product strategies to follow, I think the proliferation of these is just beginning.
So generally these ETFs thrive in volatility, but what happens when markets are calm?
Well, again, you will see generally the buffers stay the same, and you will see the upside capture or the upside cap in the capped products change a little bit based on volatility, or interest rates even have an effect because these are options pricing. And so I think that you look at this much like you would look at your S&P investment. Now, we know full well that it won't beat its benchmark on the upside. it will beat its benchmark on the downside. And so that's a trade-off we choose in the hedging world or the risk mitigation world, and I think investors are comfortable with it. So when I see these products, I certainly recommend that you blend it with your core equity holding and you view it as an equity holding because they are equity based.
That was Loukas from TrueShares. Don't forget, you can watch more videos on Reuters.com.